I'm looking at your notes here. Year-end 3,000 price target for the S&P. Break it down for me.
Sure. Well, look, the last 24 hours tells you a lot about the market being just modestly down today. You've had, by all accounts, an unsuccessful summit in Hanoi. You have tension between India and Pakistan. You had Mueller testimony, Michael Cohen testimony yesterday. And here we are. The market is barely moving to the downside because, in the final analysis, the economy is still good, and that's a positive for stocks.
So what is your read-through then in terms of the Q4 GDP number, and what do you expect that to be coming into 2019?
Well, so that was excellent. You know, better than expected. But in fact, what it actually does is cushion the psychology for what is likely going to be a weak first quarter. But we know that, and markets don't fear that which we know. You had the government shutdown, you had the plunge in consumer confidence, which is reversing itself, and you had this polar vortex. Hopefully, winter will end soon. But all of that is going to cause GDP to be, maybe 1%, maybe even lower. But the important thing is, full year, economists aren't taking their numbers down, and that's the kind of strength that we saw in that fourth quarter number, which, again, to us, given the fact that psychology is very defensive still, despite the rally we've had the last couple months, we think stocks end up moving higher.
Lindsey, do you agree with that? Do you think stocks are going higher? And when you look at some of the data we've gotten here in the U.S. just this week, I mean, it's been largely stronger than expected. And then, of course, we got that data point just a little while ago from the Treasury Secretary that IRS refunds are actually up and tracking what they have in years past.
Well, I think to your point, the data has been better than expected, but the bar of expectations seems to be just continuously lowered at this point. Now, specifically focusing on the fourth quarter GDP number that we got this morning, absolutely it beat expectations, but we're still talking about a three-quarter low. So very clearly we were losing momentum in the domestic economy over the last 9 months, and there's a number of anomalies in this number that still have to be reconciled going forward. Fourth quarter consumption, very strong, up near 3%. Of course, we did see very disappointing retail sales figures. So again, we're going to have to see some revisions and some reconciliation, excuse me, to get those numbers to really paint a clear picture of what's happening on the consumer side. Even in terms of business investment, we saw investment near 5%. That's just about a third of what we saw in the prior quarter. And when we look on the monthly data, we see 4 of the last 5 months trending negative. So again, something has to be reconciled there as well as we move forward. But I think the takeaway is for the Fed, we're still on steady ground, but this raises even more question marks, raises more uncertainty about the direction for the domestic economy as we move further into 2019.
Yeah, Julian, just to pick up on Lindsey's point about the Fed, when we got the GDP number today and then the Chicago PMI came much stronger than expected, you finally saw Treasury yields nudge higher. They've really been stubborn. They've been at the low end of their range. Two-year note kind of popped a little bit. Maybe we've lost a little bit of that. At some point, though, if we see continued strength, are we going to have to start having the conversation again about just how out of the game the Fed is for this year?
No, I don't think we're going to, because you look at core PCE came in at 1.7 this morning, a little better than expected, but you're still very far away from that 2% number. And so from our point of view, what the bond market is telling you now is actually inflation is not dead, but it is recognizing the Fed's on hold. And so it's natural, it's actually healthy, particularly given European yields as low as they are, to see the 10-year yield tick up. And if you look, the response in the stock market is that financials are having a reasonably decent day relative to the rest of the market so far, and that's all positive.
Lindsey,
well,
when you look at
inflation at 1.7%, that's not actually that far from 2%. I think that's very much in line with the Fed's assessment of inflation being near their longer-term objective. And you couple that with growth coming in stronger than expected, well above 2%. These are the very conditions that warranted a more aggressive rate path in 2018. And so there are going to be the members, the more hawkish members on the Fed come that March meeting that are going to make the case for at least another 25 basis points. But as we move further into the year and domestic weakness then becomes more prevalent, and that becomes the primary catalyst for keeping the Fed on the sideline, the next rate move, if we don't see one in the near term, is likely to be to the downside, meaning a possible rate cut.
Lindsey, do you think we could actually see a rate cut, especially when, I mean, you just laid out a case that arguably suggests that the Fed shouldn't be waiting, they should continue to tighten? At least for now.
Remember, all this data is backward looking. It's all looking in the rearview mirror.
Yeah.
So for the more hawkish Fed members, they're going to make the case that we should see a move potentially at the upcoming March meeting. But I think more broadly, the Fed is going to maintain a more patient stance as they're looking to the future. And the expectations of weakness should not only keep the Fed on hold, but we could be talking about, as you mentioned, that rate cut sooner than later.
Julian, you were shaking your head no before. Why?
So the bottom line for us is the Fed is on hold well and truly. Our view is that the people that are expecting a rate cut, that's not going to happen. Clearly, the data says that that's not going to happen. But actually, if you're the Fed, you're in the sweet spot now. Less talk, more inaction. Let the data speak for itself, and we can decide later in June, September, whatever, which way things need to go.
If that's the
well, you can't remain in the
for
sweet
the
spot
foreseeable
forever.
Yeah, Lindsey, go ahead.
Well, you can't remain in this sweet spot forever. At some point, the Fed is going to have to make a decision on the directional momentum of the economy. And it can't continue to just pander along at this 2% pace. So the Fed is either going to have to say, look, in the near-term future, by the end of the year, we're either going to have to continue to support the economy, or the economy has maintained enough momentum that we need to take action to the upside. So they're going to have to make a decision at some point.
I was just going to say, Julian, if we use that as a premise that the Fed for now looks like it's essentially sidelined, how much farther can that take the market? I mean, you mentioned that investors remain kind of defensively positioned, but we've rebuilt valuations back toward an average level. We still have the first half of the year. The earnings are going to struggle to grow.
There's no question about it. And if you look at where valuations are based on consensus earnings, they definitely look expensive. Our view is that the combination of a stronger than expected U.S. economy after this first quarter soft patch, and importantly, China reflating. There's stimulus in the pipeline. Look, we don't know if we're going to get a deal or not. It seems like we're going to, but there's stimulus in the pipeline. That's a second half story. That boosts growth globally, Europe and the U.S., and they can continue to just let it evolve. And that's how stocks get to 3,000 in our view.